Thank you all. This is a really interesting, very timely talk. We just went through our renewal at Intermountain Health, and so I figured we might be able to get some nuggets out of the process that we've gone through and just sort of general things in the industry to give you some very actionable steps if you can. That's the goal, ultimately. We're going to talk a little bit about some basics, absolute musts in order for you to be actually insurable. This is really important, especially if you're in the smaller size space. The cyber insurance underwriters have really started drawing hard lines on certain things. We're going to spend probably a fair amount of time going through that. I want you guys to make sure you understand what all those controls are and get into some of the specifics of it. And then, as Jeremiah said, we're going to talk a little bit more about what does value look like in a renewal, some strategies associated to that, maybe some other tidbits around what you can do through the onerous process of actually going through a renewal, because it is very onerous, how you can leverage that in other ways too. And then that ultimately, at the end of the day, what you're looking for with your insurance carriers is to be known as a good risk. A good risk means that they want to take on more capacity. They want to take on more items and partner with you and not sort of try to figure out how to hedge their bets associated to your program. Before we get into that, though, I want to tell you a little bit about Intermountain so that we can set the stage and context. We're a healthcare organization. We are 7 states, 65,000 employees, $16 billion in revenue, 33 hospitals, hundreds of clinics, a health plan that covers 1 million lives, 21 million patient records. We're big. And so I want to use that to set context, because when we go through this process and sort of how we're architected and designed, it's very dominant design. There's a lot of on-prem stuff. There's a big network. There's a lot of tech inside that network. We do have a cloud presence, a fairly substantial cloud presence. But it's not a digital company per se, where we have a zero footprint, kind of perspective. We have 5 data centers, So, I mean, it's just the context of that, I think, is important as you're thinking about the talk. Your mileage may vary depending on the kind of organization that you are. So hopefully that helps, especially when we talk about some of these main controls that have to be in place. And of course, if there's any questions, at the end of all of this, I'm happy to take them, and we'll go from there. I don't have a lot of slides either, so we'll kind of just dive into it. Go ahead and feel free to start taking pictures if you want. So as you're leveraging your renewal process, hopefully you have a broker that you're working with, and the broker, their job is to collect and work through demonstrating and identifying your program to the degree that's needed for all the underwriters that are going to underwrite your program. These next 2 slides are ultimately based around Marsh McClellan's latest 12 key controls. And this is, if any of you were in the CISO Summit yesterday, there was a gentleman that spoke at that talked a little bit about this and then went right into the science behind where these 12 controls came from, which is great. So if you were there, then hopefully this will connect to that. There are 5 that if you're not doing will potentially make you uninsurable right out of the gate. And these are not sexy, unfortunately. This is not the stuff that you're going to go into the vendor hall and find the next whiz-bang thing. It's most of this, all of this, is very practical hygiene. It's very practical core controls. It's the stuff that can easily change, where today you might have it in place and tomorrow something new is entered into your environment. Maybe you're adding new technology, maybe you're replacing a technology, and one of these controls gets missed, and then that becomes the barrier of entry, or the access into your environment. So, these 5 controls, it's really about, you got to make sure you have a solid program that's covering hygiene. Hate to say it, hygiene is how we are getting beat, in the industry. As part of my side gig that I do, in addition to being the VP of Intermountain and CISO for Intermountain, I am the chair of the Cybersecurity Working Group for the Health Sector Coordinating Council. And that is one of 16 critical infrastructure that has been identified under the National Defense and Authorization Act. And we work with HHS, Department of Health and Human Services, in a capacity, a public-private partnership capacity. And we've done, just this year, we actually conducted a study on hospital cybersecurity resiliency. And we looked at major study elements to find out how is it that the hospitals today are actually getting beat. Now, healthcare is way bigger than hospitals, as we all know. I mean, there's hospitals, there's plans and payers, there's medical technology, pharmaceuticals, labs, et cetera. I mean, we're multi-trillion-dollar part of our GDP, so it's massive. But our focus on that was, zooming in on how we're getting beat, generally speaking. These 5 controls, I didn't actually have this when we were conducting that other study. They line up perfectly. Because the way the hackers are getting in, you always have to think about this in the life cycle, right? So it is the fish that gets you into the environment. It's the beachhead that once they're in, they quickly move over to another asset. It's the find to the privileged access, that admin that's running their workstation that's connected directly into a domain controller. It's pulling the credentials straight out of memory, or watching or putting a keylogger on, or patching the hash or something like that. And then boom, you're up into domain admin rights without two-factor authentication, and you're owned. It's done. I mean, that's the attack. Unfortunately, that is the attack. There's a lot of super sophisticated things that can happen, of course. But by and large, when you're seeing these major disruptions that are occurring, it's something along those pathways. So we just start off on the left here, multi-factor authentication. Your cyber insurers are going to be asking you the question, is every single asset that is exposed to the internet multi-factored? You want to be able to say yes to that question. Or you want to be able to say yes to a very compelling answer as to what you're doing about the assets that you know are not multi-factored and are perhaps into your pipeline. The second one, endpoint detection and response. Notice I do not say a SOC. A SOC is not the mandate right now. The mandate is having EDR in place and having somebody watching EDR in a 24/7 basis. So you could get this through a managed service provider. You could do this, inside your own organization, and that's all fine. But you need to have some kind of coverage, some kind of monitoring that's beyond somebody gets paged and woken up in the middle of the night, to work on a ticket that gets introduced. That would not be 24/7 coverage. Secure backups and testing of those backups. Why? Because ransomware is the major threat, of course, that is at play, and you need to be able to demonstrate that you have tested and validated those backups, or you've done tabletop exercising, you've scenarioed this, and you can demonstrate how you talk through that and talk through how you've actually conducted those. On the privileged access management side, we all know PAM is huge. You can have tens of thousands of service accounts, all kinds of different things. You have vaults with credentials all over the place. It's not saying that you have to have that in play. But what they do want, specifically domain admin accounts, they want you multi-factoring those domain admin accounts. If you haven't done that, you might be considered in that uninsurable space. It's very tactical, very specific, very key. And really, the reason why that's important is it's easy to lose sight of that at times. And they're backing all of this based on their claims data and the data that shows how those organizations that have been hit with a ransomware attack or some other major incident have actually been compromised. And then the last one is, of course this is basic, but it's your email filtering, it's your URL click protection, it's your automated response. You get an email, you send it off to the SOC, you have a button that you click, a phish report button, something along those lines. And your web proxies, your outbound browsing web proxies just to block malicious activity. Not sexy. We've all known this. This is 15 years old, right, at this point? But the difference is now we have an outside party who's applying pressure that says, you will do this. And if you're not doing this, we're gonna start making it harder for you. On the other controls, there's a bunch. Patching, of course, you might want to say, like, why is patching not on the first 5? Ask Marsh that question. This is their specifics. So I went through their control base and just kind of summarized it here. So, patching, getting that scanning in, monitoring CISA, the Cybersecurity and Infrastructure Security Agency. They have a list of known exploited vulnerabilities, KEVs is what they call them. That should be in your list. A vulnerability management program, you get lots of stuff that's out there. Even if you don't have any of the cool tools that can help synthesize and provide context to those vulnerabilities, if you can get a KEV program in place and you can down select to that, and then you can compare that to your exposed assets, you're going to be in a good position. Your incident response plans, the one here, crisis management and tabletop exercising. Crisis management is not your SOC running its high severity incident that they're working through to inoculate. Crisis management is your organization running through a scenario of your digital systems are down. What do you do for the next week, 2 weeks, month, however long that looks. And then how have you tabletop that? We call it our large-scale incident response plan, but really it's emergency operations in a critical infrastructure context, in a hospital setting. I mean, this very much deals with people's lives. The emergency department, the trauma department, these things all run on technology. And so if those go down, those systems go down, we have to have a plan in place that we have exercised, we have looked at, we know how to decompress, go on diversion, work through the issues associated to that. And they want to see that we've done those exercising. More than once a year would be ideal, honestly, if you can. They actually want to see 3 to 4 times a year. Your awareness and training, this is your standard, fish simulation. I'm sure you're all doing that. Do that on a monthly basis, though. I've seen some people that have said you only need to fish quarterly. And some people say that, fishing simulations are just not helpful anymore. I like to think of the phishing simulation more as a metric to get a state of where is my organization at from a susceptibility perspective and where are they at from a responsive perspective. So we track both the clicks as well as how many people inform us that there's a fish simulation that came in. And we have metrics that we want to stay above on the informing. The informing is more important than the click, in my opinion, because you can make anybody click on anything. But you want everybody to tell you about it so that you can act very quickly and with purpose. Hardening, the restricting inbound ports, I'm still honestly utterly shocked that we are getting beat through our open RDP on the internet. Who's doing that? But it happens over and over again. There are organizations that just have it open, and that is how they get in. That's the foothold. So how it's happening is going back to hygiene, we might think that it's all stopped, but when was the last time you validated that? When was the last time you verified that that was actually the case? And don't just assume that because you verified it last year that that is still the case. The environments change all the time. And with hygiene, you've got to stay on top of it. Login and network protection, this is where your SIM comes into play. This is your SOC playbooks. And end-of-life systems, third-party risk management. So lots of stuff happening, obviously, in the third-party risk space. And this is one of those things as well where I don't think that we're in an ideal situation yet. We all have our questionnaires. Maybe we're using tools. Maybe we have Excel spreadsheets. Many of you are vendors. We all have built up armies of resources on both the asking and risk assessing side and armies of resources on the vendor side to answer the question. Armies of people, all so that we can understand what the risk is. And there's nothing new that is being introduced as we're doing that. When at the end of the day, what we really need is to know, are these risks actually being mitigated? Are they being managed out of the organization? If a peer of mine has conducted an analysis against a vendor, and we can take the context of specific integration off the table, but just general vendor management. If a peer of mine has done that, why can't I not trust that? Well, what is unique about what I'm doing that is going to make a decision in my organization in a different way? So I think that there is a lot of work on this, obviously from an insurer perspective, because a lot of breaches that are happening are third parties or fourth parties, through the third parties. And so they want to see that, we're out there evaluating these risks and we understand it. In the context of critical infrastructure, I think the nuance here is don't just focus on data. Data is, how we grew up as a profession. But business interruption has nothing to do with data. It has everything to do with availability of our systems, availability of data, one can argue. But it's a different context. It's resiliency. It's about how to make sure that those things are up and running. Our third parties might not have our data, but might be incredibly important to our business operations in such a way that we might not even be thinking about it. So critical infrastructure, hospital as an example, laundry services. They have orders, they have technology platforms, they run, they place orders to, churn out beds and all of that kind of stuff and put new sheets, into the hospital. If we can't change a bed, we can't put a person in the bed. And that is a case of a vendor that's actually important in a critical context that is not one that prominently comes to mind when we're thinking about this from a cyber perspective. So that, and then the third, of course, is with third party is the conduit access into your environment. So if they are connected into you, and in healthcare it is an ecosystem, there are no four walls anymore inside of healthcare. You do not run this system without hundreds or thousands of vendors that are part of it. And of course there's major connectivity. So when you're presenting this stake, we do this in person when we go to our renewal. And we do this in tandem with it's myself, the CFO, and our Chief Risk Officer. And we have a presence together, which is important. Because when we're there, we spend all day with our underwriters. And we do a 2-hour presentation to sort of walk through the specifics of our program. And we get deep, and we get detailed. This is not yes, no. This is everything that's gray in between the yes and the no. And the more exact and specific that you can be, the more that demonstrates to your underwriters that you know what's going on in your environment. And that's really important. That's really important for making sure that you can be considered a good risk. So when your CFO and your Chief Risk Officer are there with you, that also gives the very visual perspective of this is an organization that cares about cybersecurity. Their top executives in the organization are here with them. We travel to London when we do it and demonstrate that this is key. That's also important. You want them to walk away knowing that this is something that's taken very seriously. You guys, I think, can download, I hope you can download the presentation. I have a lot of notes inside the presentation. I'm not going to go through all of them because I don't have enough time. But there's I got a lot of specific things inside there as well if you want to dig into the presentation of the program. On my sort of strategy about when you describe the program, there's a few things that we go with. First it's starting off with what are the key strategies, key risk themes that you have inside your organization, and leading with that. Lead with you're very threat aware, and threats influence your risks. And then, understanding those risks. So in our world, our key risk themes are patient safety, first and foremost. Everything that we do is to care for our people, and we deal with people's lives, and we absolutely can deal with people's lives if something goes haywire. Harm can happen. We deal with the security of our financial assets. I mean, this is literally just fraud. The BEC attacks, the EFT attacks, those different types of things where they're stealing money out of your coffers. And so how do you build your program to support that? Privacy and confidentiality. That's the classic. We've got sensitive data. We've got to secure the data that's regulated data and what we're doing to support that. And then the fourth is what I call complexity. So as you grow, as you bring in new environments, you have, we're going through what we call inorganic growth. We're acquiring a lot of organizations. And as you do that, you bring in all the baggage, all that technology debt with it. And so M&A processes is really important to covering it. So go through that. Go through how you govern your program. Go give them the demographics. They want to see, they're going to want to see your record count, both on PII or PHI through healthcare, what your credit card numbers are, what your storage and credit card is, what your transaction accounts are, transaction numbers are. Be exact with those, again, because when you're exact, you demonstrate you know exactly what is in your environment. And then look at what are the various benchmarks that you can compare your program to. So do you have a cohort in your industry that you can stack yourself up to? Or have you brought in outside firms to validate your program? That's always very powerful when you can do that. It's expensive, but it does help provide a good understanding that it's not just a self-assessment or my perspective on how good things are. Because if I'm going to say it, I'm going to be biased towards, we're wonderful. Of course you want to insure us. Why wouldn't you want to do that? We're doing all of the wonderful things. And then lastly, what are the things that you're doing? What are the active projects that you're working on? And what are those key controls that have come from your risk management strategy? Ideally, an enterprise risk management strategy, and you can demonstrate how that's connected. So when you've done all of this, you can ask your broker. So I put together a fictitious model here of a $10 billion organization. You can ask your broker or Cyber Insurance or whomever to give you some simulations on what are the types of events that could happen and what are the likelihoods that could occur. When you do this through Marsh, you submit all of this. There's 500 questions. It's crazy. You submit all of this information up, and then they run some Monte Carlo simulations, and then they churn out some results for you and show you some math. Now, we can argue about the math, and that's fine. But generally, it's supposed to be directional. And when you think about it, the goal in all of this is anything below your retention is what you're going to cover out of pocket. These are going to be your more likely scenarios from occurring. Your 1 and 2 events. Your 50% opportunity, your 20% opportunities for these things to occur. In this model, a privacy breach is the most likely breach to happen at 25%. So every year there's a 25% chance that is going to occur. The next one is a business interruption, non-ransomware business interruption, and then a ransomware event at 2%. Your limits that you have, so if you look on the right, is 70 million. Again, this is a fictitious number. So that when you look at this, so you're paying out of pocket 1 out of 5 times. This is what your CFO is going to be looking at, what your chief risk officer is going to be looking at. Your average, they should be able to tell you what the average loss would be. So again, this is based on their data, their claims history, and their models that they have. They can roughly tell you what that average looks like and what that likelihood of that average is going to be. That's good to know because that helps you understand what your capacity should look like. And then your limit, of course, is where your probability, your limit hits the probability. So in this case, it's a 1 in 25. So then the question is, when do you, all of this to the right is yours. If a 1 in 50 and a beyond event occurs, it's coming out of your coffers, your treasury. And this is where the value comes in. So, I asked this question recently, if I got a great program, my premiums are going to go down, right? And the underwriters looked at me like I was nuts. Like, what are you talking about? No one's ever asked us that question. Why would that happen? And I was like, well, because it's not going to happen, right? Wouldn't we see that happen? They're like, no. The market dictates, this is what they say, the market dictates where the premiums are at. And that's generally based on the average aggregate of everybody, how the claims are looking, how they've insured their organization, who they've kicked out of their portfolio in order to get to good risk. And this year alone, last year was terrible. Last year and the year before, we saw rates of 100%, 200% increases. Some people had 300% increases. This year, everybody, by and large, is going down significantly, 6 to 9% increases. Well, we might not have done anything, so why did that happen? It happened because they changed their risk models and they changed their portfolios in order to only have the organizations in that they think are insurable. That's the baseline. Are you insurable? So when it comes to value, what you want is you want them clamoring to have more capacity and more items covering these elements. So let's talk about that for my last 3 minutes. So this is kind of like what a typical you got a primary insurer and you got excess insurers. In this case, you've got 6, 7 different underwriters that are underwriting your policy. Your retention in this case is $5 million. Again, fictitious. I made this up. Your primary insurer is covering $10 million. Your secondary insurer is covering in excess of 15. So that gets you to $25 million, and then it goes on down. The premium cost is what they're costing for the actual coverage. This is how it will look. And then your price per million is the actual metric that's used to determine how costly is that line in the tower for this policy. The higher up you are in this tower, the more likely that insurer is going to have to pay out. Because again, the first one's 10 million. So that first one is going to cover those low likely events, those 1 in 5 events kind of thing. And then the secondary comes in, and then the tertiary, and so forth. So that's the reason why these numbers are higher. It costs more to be primary. And when you're lower, but depending on how you're looking at it, higher in the stack, lower in the stack, whichever way you're going, when you're lower in this table, the costs come down. And that's strictly because chances are that that's not going to occur. It's more unlikely that you're going to need to get to that high. So value, how do we get there? One is these secondaries, they want to get higher in this tower. They want more. They want more because they want more money on the premium because you're considered to be a good risk. So they're willing to take on more risk. That's value number 1. Value number 2, you could have these secondaries competing for primary. And primary means that they're the first ones that you go to. They're the ones that broker everything, essentially, when you're working through a claim. And at primary status, it comes with that premium, but it also comes with the relationship and a lot of other pieces to it. You could have increased capacity at the same price per million. So these underwriters might come in and say, well, last year we were only willing to cover 15 million, but hey, we really want to get up to 20 now. And we're not going to change our price per million on that because you're a good risk. So that is moving up that chain on that last slide, moving you farther to the right without really increasing your coverage that much. You could get lower prices per million. So it is possible. If you've got good competition happening between these people because everybody's clamoring to get up higher on that stack, you could get better rates. So that is the way that you could get to better rates because you've got a good program. And then lastly, your retention. So the retention, they might be willing to lower that. So they play the games, right? So if you're at 5 million, maybe they'll go to 1 million because again, you're considered to be a good risk. So this is stuff that mostly your chief risk officer and your CFO and your board is going to care about, but I think this is really important when you're looking at it from a cyber context, and as well, it helps us kind of understand how we fit into the bigger picture in the financial relationship. I have 10 seconds. Oh my gosh. I will take questions off to the side, but thank you very much.